Hi, and welcome. In this video, I'm going to be talking all about IRAs. Specifically, in this video, I'm talking about traditional or deductible IRAs. I have a question for you. Do you like bubbles? Do you like bubbles? Do you like bubbles? I like bubbles. My grandkids love bubbles. The reason I'm talking about bubbles is in order to understand an IRA, it's great to picture a bubble, a tax-deferred bubble. When you make a contribution to your IRA, you're putting money into the bubble, and at that time, you get a tax deduction for the amount that you contributed. In most cases, more details in a minute. As of 2022, the IRS allows us to deduct up to $6,000 in a traditional IRA. If you're over 50, you can deduct up to $7,000 per year. Generally speaking, you have until the tax filing deadline, which is usually April 15th, to make an IRA contribution for the prior tax year. You do have to have earned income to be able to make a contribution. Your contribution cannot exceed your earned income. One exception to that is non-working spouses. Not everyone can deduct the full IRA contribution, depending how much you earn, whether you and or a spouse participate in a retirement plan at work. These variables can reduce or eliminate the deductibility of the IRA contribution. Here are the details if you are covered by a plan at work and if you're not covered by a plan at work. Feel free to pause the video if you'd like to take a closer look at these details. If it turns out that your deduction to a traditional IRA is reduced or eliminated, you might want to consider a Roth IRA. It's a different kind of IRA. I'll put a link in the description below that talks all about Roth IRAs. For all the years that the money stays inside of the IRA, this tax-deferred bubble, you won't get taxed on it. It's allowed to compound and snowball and grow. Money that would have been paid into taxes each year in a non-IRA account is still in there, snowballing and compounding and growing for your future. Someday in the future, you're going to take money back out of the bubble. At that point in time, any money taken out is then taxed as ordinary income. The whole reason the government allows us these deductions and tax deferral is they want to encourage us to save for our retirement. There must be some trade-offs, and indeed there are. If you take money out of an IRA before you're 59 and a half, the IRS will not only tax it as ordinary income that year, but they will also add a 10% penalty. There are some situations in which you can take money out before 59 and a half without incurring the penalty, and here they are. The other important age with IRAs is 72. Once you reach the age of 72, you must begin withdrawing a required minimum distribution. What's that mean? It's just a little bit that you have to take out of your IRA every year. You want to make absolutely sure that you do take out the required minimum distribution every year starting at age 72, because if you do not, there's a 50% penalty on the amount you were supposed to take out but did not. There is a way to satisfy the IRS's required minimum distribution rule and not be taxed on the distribution. It's called a qualified charitable distribution, or QCD. We have a whole separate video on that. I'll leave a link in the description below. The I in IRA stands for individual. Sometimes a couple will ask me, are both of our names on the IRA? And the answer is no, it can't be that way. The IRS requires that an IRA be owned by an individual. In most cases, the spouse is the named beneficiary on the IRA. Speaking of beneficiaries is an important part of an IRA account. So when you open up an IRA account, just like with if it's a 403B or a 401k or other kind of retirement accounts, you're going to name beneficiary or beneficiaries. You're going to spell out who your primary beneficiaries. You're going to have the option to add contingent beneficiaries. That says if something happens to you but the primary is gone too, then who does it go to next? That's what a contingent beneficiary is. I have a whole nother video, I'll leave a link in the description below, on the importance of naming your beneficiaries properly and the importance of keeping them up to date. Check out that video in the link below. If you're finding this video helpful, do me a favor and click the like button underneath the video. That helps more people to see it on YouTube. Thanks, I appreciate it. One big advantage to having an IRA account is that you can use it to consolidate old retirement accounts that you may have with ex-employers. So if you've got a 401k or a 403b, what have you, at an old employer and don't really want to keep it there, and there are a number of good reasons why you should get it away from them, you can roll it over into your own IRA and consolidate everything in one place. There are a number of reasons why it's smart to roll over your old 401k into your own IRA. There can be a couple of circumstances under which it's not smart to do so. We're creating another video on the pros and cons of rolling your 401k into your IRA. If you'd like to know when that video comes out, please click on the subscribe button and on the little bell so that you'll be notified when that video comes out. Not only can you roll over old 401ks into your IRA, you can consolidate other IRAs into one IRA. So if over the course of the years you've created an IRA here, an IRA there, don't even know why you're still invested the way you were, and maybe it's not appropriate today as it was when you first opened it, you can consolidate any number of old IRAs into one IRA that's suitable for you now. With both a 401k rollover or an IRA transfer, make sure that it's done properly. Consult with a qualified financial advisor. You want to make sure it goes from the old custodian to the new custodian. None of these rollover or transfer checks should ever be made payable to you. Whatever you do, don't cast a check like that, or you can have a huge tax liability. Sometimes people misunderstand the difference between an IRA and the investments in it. Sometimes people will say, well, what's the return on my IRA? What you really want to ask is, what are the returns on the investments that are in my IRA? Remember, the IRA is not an investment. It's just the container, the bubble, inside of which you have whichever investments you want. And it's the investments inside the IRA, not the IRA, that have different rates of returns. Which brings up an important point. You can invest your IRA in any number of things. You could go to the bank and open up a savings account IRA or a money markets IRA, or you could go to a mutual fund company, or you could come to a financial advisor and build a diversified portfolio. The importance is the rate of return that you earn, compounding for years and decades, is going to make a huge difference in whether your IRA grows to a little or whether it grows to a lot. Again, speak to a qualified financial advisor to decide how to best invest the monies in your IRA. To view our playlist with all of our videos on the topic of IRAs, click here.